Imagine you have a business partner named Mr. Market. Every day, he comes to your door offering to buy your shares or sell you his at different prices. Sometimes he's excited and offers a high price. Other times, he's gloomy and wants to sell for very little. The catch? His mood changes daily, and it often makes no sense. Mr. Market is not smart. He doesn't care about facts or real business performance. He reacts to news, fear, hype, and rumors. One day he's overly optimistic. Another day he's terrified. Benjamin Graham uses this story to explain how the stock market behaves. Here's the key idea. You don't have to follow Mr. Market's emotions. You can choose to ignore him or take advantage of his mood swings. When Mr. Market offers a price much higher than a company's true value, you can sell to him. When he offers a price much lower than what the company's worth, you can buy from him. And when he's acting crazy, just ignore him. The mistake many people make is treating Mr. Market like a wise guide. They panic when prices fall and cheer when prices rise, just like Mr. Market. But smart investors don't copy emotions. They stay calm and only act when it makes sense. This mindset gives you power. You're not controlled by market fear or hype. You're the one in charge, so what should you do? Know what your investments are really worth. Don't sell just because prices fall. Don't buy just because others are excited. Use Mr. Market's foolishness to your advantage. If you act based on logic and research, you'll often find good opportunities when others are panicking. That's when Mr. Market offers bargains. The lesson is simple. The market is there to serve you, not to guide you. Imagine you're building a bridge that needs to support 10,000 pounds. Would you design it to hold exactly 10,000 pounds? Of course not. You'd build it to handle 15,000 or 20,000 pounds, just in case. That extra strength is your margin of safety. Benjamin Graham says you need the same idea when you invest. Let's use a basic example. Suppose you think a company is really worth $100 per share, based on its earnings, assets, and future potential. If the stock is trading for $98, should you buy it? Graham would say no, there's no margin of safety. One small mistake in your estimate, or a bit of bad news, and the price could drop below what it's really worth. Now imagine that same stock is trading at $65. That's a big discount, 35% below your estimate of its true value. That's a margin of safety. If your estimate was a little too high, or if the company hits a rough patch, you still have a cushion. You didn't pay full price, so your risk is lower. Why does this matter? Because no one can predict the future perfectly. Businesses face problems. Markets get emotional. Even careful analysis can be wrong. The margin of safety protects you from those mistakes. This concept is at the heart of value investing. The margin of safety gives you room to be human. Investing isn't about being right all the time. It's about not losing big when you're wrong. So what should you do? Study the real value of what you're buying. Wait for the price to fall well below that value. Don't rush. Patience is power. Imagine you're at a market. One person carefully studies each item, compares prices, checks quality, and buys only what offers real value. Another person rushes in, hears rumors, guesses what might sell tomorrow, and grabs anything flashy. The first is an investor. The second is a speculator. Benjamin Graham starts his book by showing the difference between these two. An investor puts money into businesses after studying them. They ask, is this company strong? Will it grow? Is the price fair? They care about the business behind the stock. They're not just buying a name. They're buying part of something real. A speculator doesn't focus on the business. They focus on the stock price. They ask, will it go up tomorrow? Can I sell it for more? They don't care if the company makes money or loses it, as long as they can sell quickly for a profit. Many people think they're investing, but they're really speculating without knowing it. They chase hot stocks, react to news, or follow hype. That's risky. Most lose money this way. Why does this matter? Because how you think shapes how you act. If you act like an investor, you build wealth slowly and safely. You avoid fads, stay calm during market swings, and stick to your plan. But if you act like a speculator, you gamble. You react emotionally. And over time, that's a dangerous game. So what's the takeaway? An investor looks at value. A speculator looks at price. Investors treat stocks as ownership in a real business. Speculators treat stocks like lottery tickets. Let's say you're buying a car. You don't just look at the color or the brand. You check the engine, mileage, service history, condition, and price. You want to know what it's really worth, not just what the seller is asking. That's what intrinsic value means in investing. It's the real worth of a company or stock based on facts, like how much money it makes, how much debt it has, how strong the business is, and how much it might grow in the future. Graham says every stock has two prices: the market value, what people are paying right now, and intrinsic value, what it's really worth. These two prices aren't always the same. In fact, they often don't match. The market moves on emotion. Intrinsic value is based on logic and facts. So how do you use this? You buy when a stock's market price is below its intrinsic value. You're getting something valuable for less. You avoid or sell when the price is way above its real worth, because it's overpriced and risky. Price is what you pay. Value is what you get. In the realm of intelligent investing, Graham classifies investors into two broad categories: the defensive investor and the enterprising investor. These are not levels of intelligence. They reflect temperament, time commitment, and tolerance for risk. Let's break it down. The defensive investor, also called the passive investor, this person prefers safety, simplicity, and minimal effort. They're not interested in constant market analysis or frequent buying and selling. Instead, they want to preserve capital, grow it steadily, and avoid unnecessary risk. Key traits: focuses on broad diversification, prefers low-cost index funds or blue-chip stocks, avoids speculation, market timing, or trend chasing, emphasizes consistent, long-term returns. Think of a defensive investor as someone who plants a tree and patiently lets it grow. Their strategy is slow, steady, and stress-free. The enterprising investor, also called the active investor, this person is willing to put in serious work. They actively seek out undervalued securities, analyze financial statements, and monitor market developments. Their aim is not just to protect money, but to outperform the market. Key traits: spends time studying companies, industries, and trends. Looks for mispriced assets or special opportunities. Ready to buy when others are fearful and sell when others are greedy. Needs discipline, patience, and analytical skill. This is not gambling. It's focused, research-driven investing. But Graham is clear. Only those with the proper knowledge, dedication, and emotional control should follow this path. Without that, it becomes reckless speculation. The choice isn't about being smart. It's about knowing yourself. Graham's advice is timeless. If you don't have the time or temperament to study investments deeply, be a defensive investor and be proud of it. You can still build real wealth, but if you're truly willing to do the work, an enterprising approach can lead to greater returns if executed with care and discipline.